My guest is bullish on the Singapore economy but expects a correction in the near term. He says this V-shaped recovery is turning into a square root. A square root? Well, joining me now from Singapore is Timothy Wong, head of DBS Vickers Group Research. Singapore Securities Investors Association named DBS Vickers the best retail broker in Singapore last year. Tim, good morning and Happy New Year. What's a square root recovery and what do you make of the better than expected numbers this morning?
Well, I think we're kind of at the top of this V-shaped bounce that we've seen really all across Asia, especially on the industrial production side, coming from a very low base. And when we say square root, we're really talking about the top of that square root sign, which means, after the V-shape, things kind of normalize, plateau off, and our sense is going to 2010, we'll be looking at a more normalized pattern, but a fairly healthy one with 6% growth expected for the full year 2010.
The trouble with Singapore's growth is that it's pretty reliant. It is at the mercy of external factors. I mean, how can Singapore put itself in a position where growth is more sustainable?
Well, that's a very good point. Actually, one of the interesting things that we think we'll see this year is the services sector is actually going to be a key driver of growth. Just to give you a sense of that 6%, we expect 4.4% to come from services. And, it's going to be driven by things like the IR, as well as strong sort of hub, domestic services within the Asia region. So my sense is Singapore will be increasingly more reliant upon Asia than sort of global demand, especially in the next few years.
We saw what the Fed did or said today, its first move in about 3 years, and RBA now saying as well that there needs to be further tightening. How do you read all of that, and how do you put Singapore's economy in perspective?
Yeah, well, I think the reality is that monetary policy has been extremely loose since last year, and central banks all around the world, obviously led by the Fed, are going to be taking back some of that excess liquidity. From a Singapore perspective, I think what it means is equities will probably be a little bit jittery in the first half of this year. In fact, we're thinking that markets, although the economy looks like it's on good shape, markets have priced in all the recovery, and now they're going to be sort of worried or concerned about on the monetary side of things. So shaky markets in the short term, but generally we're still looking for 15–20% return for the full year.
Shaky markets, how are valuations looking at this point in time? 80% increase last year, down 4% year to date.
Yes, we actually think that the STI is probably due to correct another 10–15% in the first half. That's a pretty steep correction, just looking at it as a standalone number. But when you consider that against the backdrop of an 80% rise, I think it's par for the course. But then from that level, we expect a 20–30% re-rating as we get into the second half of the year. I think the key here is that the growth does come through in the economy, and that filters through into corporate earnings, which would then make valuations attractive once again.
Okay, so what do we buy? You're liking industrials, the laggards, you see, the likes of what, ST Engineering?
Well, no, actually, there are three names that we like. Well, within sectors, we like industrials, we like consumer services, and there are three names that we're focusing on. One is actually SIA Engineering, which is a yield play, plus it has exposure to the increase in air travel, especially with the IRs coming on. We like Sing Press Holdings as a broad proxy to the services sector in Singapore. And the third stock we like more in the industrial space is Sembcorp Marine, which was a laggard last year. We're looking at about a 20% return, which is pretty decent, given the higher risk environment we see for equities this year.
Let's look at them closely. I mean, we'll start with Sembcorp Marine. Working through backlog worth almost $5 billion with deliveries stretching through 2012 rather. How strong will demand be thereafter? What's your take on it?
We think that the order visibility will actually pick up. I mean, bear in mind that because these are big fixed asset orders that go through because of the credit crunch, a lot of the order visibility basically shrunk last year. And so this year we're really looking at a pickup in order visibility, and that will be one of the key catalysts for re-rating of the stock.
And SPH, Singapore Press Holdings, you mentioned that earlier on, one of your favorites?
Well, SPH
what kind of upside are you looking at?
Correct. We're looking at about 20–25% total return, probably about 25%, 20% re-rating for the shares, and around about a 6% dividend yield. And of course here, we're looking at stronger domestic services growth, and that should filter through into stronger ADEX for its own core business.
I also understand, Tim, that as far as consumer services is concerned, you're liking what? Singapore Airport Terminal Services. This is tied to the expectations of more visitors to the country.
That's correct, and that's a good way to play it because unlike buying one of the airlines, they don't have the exposure to oil price volatility. They're simply beneficiaries of the increased throughput through Changi Airport. So this would be a great way to, to gain exposure to the sort of medium-term goal of 17 million tourist arrivals into Singapore in the next 5 years.
Tim, before we let you go, risk appetite likely to remain low.
We expect markets to stay volatile. I think generally investors are staying away from the risky trades, moving to dividend yield plays, and it's all because of this uncertainty caused by the take back of sort of very loose monetary conditions. So in the short term, low risk appetite.
All right, Tim Wong, head of DBS Vickers Research Group in Singapore. Thank you.